And from the You'd Think We Might Learn department, easy terms for home buyers helped create the conditions that led to the housing crash last decade. But now regulators are once again tweaking the standards to boost home ownership. As Diana Olick explains, it's about creating savings and an alternative investment to stocks.
Can't afford a down payment for a home? Well, it's about to get easier with new loans from government-backed Fannie Mae and Freddie Mac requiring just 3% down.
I think there's a big problem with this because we've lived through it already.
Government is pushing home ownership again, claiming it is the best way for middle America to build wealth. But is it really?
It would be perhaps smarter if wealth accumulation is your goal to rent and put money in the stock market, which has historically shown much higher returns than the housing market.
Going back to 1987, when the S&P Case-Shiller Home Price Index was invented, stocks win by a long shot. They're more volatile, yes, but long-term, they yield owners more, not only through appreciation, but through dividends. Home prices do rise over the long term, but you have to pay into a home in the form of property taxes, insurance, maintenance, improvements. You do have to pay capital gains on stocks, but it comes out to much less. On the other hand, home ownership produces social yields.
The point is that home ownership is also a state of mind. It tends to produce people who are good citizens, who are involved in the community. They know the name of the mayor.
Shiller actually charted this back to the turn of the 20th century, and it does hold up for over 100 years. But on the other hand, you could argue that a home pays you in kind. That is, you get to live in it. So it's more of a consumption vehicle, like a car, than an investment vehicle, like a stock. What it really is, though, is a savings vehicle, because that's what you're doing when you're paying down a home loan. For Nightly Business Report, I'm Diana Olick in Washington.